All right, all right. Good morning, everybody. So we're looking at uh, crude lifting up. This is connected to potential sanctions on Russia. Remember that when it comes to mining metals, the cost of crude has an impact. The other one today is maybe a little tariff talk with China. It seems to be a back and forth kind of double statements. Everything's fine, but we may increase costs or may increase tariffs. It's like talking out of both sides of his neck. So, you know, that's a part of the playbook. Keep everybody off balance. I posted that checklist 1 through 10 of the tariff confusion game plan and just follow that and it'd be good. Dow down the most this morning, but it's a measly, paltry amount, less than a quarter. Flat is good. It gives us a starting place to run higher. Small caps up the most, but just barely above a quarter of a percent. So that would be the regime change I would be looking for this morning. Swap out the run from small caps with the drop from the Dow. See that transition as a signal to maybe get something done. I had to restart the Thinkorswim. Right when I was getting ready to go. So let's just get that fired back up. We're not going to get the data today that we're expecting to get, these job numbers. But we've got auctions. We still have a threat of credit downgrades every day that the government is shut down and can't get their act together is another day closer to the threat that the US does see a downgrade. And it's very possible that that's going to be the flip, the line in the sand that finally breaks things and causes a little bit of a flash crash. The call wall rolled back up to its previous levels. So it didn't go any higher, but it did move back up. Once we get done with the auctions today, that pretty much should be it, other than anything that we get out of the White House. All right. So speaking of the White House, at 3 o'clock today, we're going to see comments from the president. He's going to make an announcement and then he's going to give a speech. I'm encouraged though at this point, with us just being down a little bit, it offers the opportunity to go in either direction without too much influence on one side or the other. We are inside day, but it's a really big bar, so no compression logic at this point. Doesn't really help out. We're below the mid, and we're tangled up with the three moving averages, 20, 10, and 3. We had the surge signal back here, but it just faded out. So now we're looking to see if price is going to break this 20 period daily and bring the 10 and the 20 back down below it like it did back here. All of this still residing inside of that one Friday bar. That's your mother bar, your boss bar, call it whatever you want. It's the bar in control. You have to get outside of this bar to get anything else done. And as long as we continue to sit inside it, we're not in a bear market, we're not in a bull market. We're just waiting, and we're building out more and more structure on either side of it. As long as we're in this range, longs and shorts can continue to get into this and not know that they're right or wrong. And, to be fair, there's an argument to be made to take either side. We're nowhere near OPEX, so that's not going to help. We've got FOMC right around the corner, and we've got the government refunding QRA is right around the corner. So we have to get through those before we can get to OPEX. And I think this will be resolved before we get to OPEX. All right, so on the intraday today, you can see the 10 period daily moving average, 67.32 cog line. We got the 3 period just above it and the 20 period right below it, and then 0 gamma. Because we really haven't gone anywhere, our opportunity to hit either side is pretty much equal. Due to the volatility and the violence we've been seeing, we could hit both sides. That's not off the table. Yesterday was a really nice stopping point on the full ADR. That's why we put this thing on. The entire idea is trying to identify if the market behaves in a normal, rational way, how far should we go today? Staying between the red lines would be getting the day done by splitting the ADR in half. And if we get bullish or bearish, then getting to the yellow line gets the ADR done in a single direction. And that's what we got yesterday. Now, this is not supposed to be some line in the sand where it stops perfectly right on the level and turns around, because, well, that's what video games do. The idea is that distance is about as far as it's supposed to go, because on average, that's as far as we have been going. So as long as we were behaving in a normal way, doing what we have been doing, that is supposed to be the turning point. And that's what we got. So for today, we could hit either side because both sides are inside of yesterday's range. And there's no reason to think that we're going to break out of that range today unless we get some sort of unknown catalyst coming in and hitting us. It could be the president this afternoon, or it could be announced headlines before that. There was some talk about crude already moving because of additional sanctions on Russia. So even though the economic calendar doesn't have anything that can get this done, give us a breakout, we've got enough potential headlines today that could get it done and give us that breakout, up or down. I don't want to make it sound like this is a bearish proposition. But at the moment, as it always is, we GTFO. You got to get out of the box to get anything else done. Yesterday, we had a very narrow channel. A narrow channel implies that if we break out, the breakout sticks and we continue to run. And we did that. So that's kind of nice. It actually gave us what we anticipated. Today's floor pivot is lower than yesterday's. That's bearish. Price opened underneath that pivot. That's also bearish. We've already hit the pivot, so we have no reason to anticipate that it's owing us any sort of a move. And we've ran through the pivot enough times today that it should not act as any form of support or resistance. At this point, it's just a horizon line on whether or not we're above it or below it, much like how we treat the weekly. When we're above the weekly, we're mostly in a bullish posture. And if we're below the weekly, then we're in a bearish posture. I would treat today's pivot the same way. As long as we can maintain above that floor pivot, we should be looking for long opportunities. And as long as we're below it, we should continue to seek out short opportunities. Because of the radical move that we saw yesterday, today's S&R lines are a long ways off. S1 is at 88. R1 is at 87. I mean, really, that's close enough to be a 100-point part. 66.88 to 67.88. That's a 100-point range. Get her done. I don't anticipate hitting twos on this. So, going from an R1 to an S2 or an S1 to an R2, it's kind of off the table today unless we really get some news that the market doesn't like. One catalyst that I think the market wouldn't like is getting a downgrade, but that is a really big step. And I don't see it happening yet. I think after like a 30-day mark, because this is like what, day 23 of the shutdown. Once we get past the 30-day mark, I think we could see more attempts to influence a resolution, like getting a credit downgrade. That's ammunition in their arsenal, and if they fire it off too soon, well, then that's just one less bullet they have to fire later. So I think they're gonna hoard that and use it in a more appropriate time. We are developing a classic P-shaped profile, and this is the one that the textbooks talk about, right? If we just steal a little bit of Friday's price in that measurement if I was running like an anchored profile rather than a time-based profile. In the textbooks, when you look at these P-shaped profiles, it talks about having a run up and then a consolidation across the high. Well, not all profiles are built from that sort of behavior, right? Like the one we had back here, where we spent a week sideways and then we dumped at the end of the week and we created that P-shaped profile. Run it the other way around, there's our run up and then a distribution. Problem is, I'm stealing Friday's price to get that P shape because we don't have it. What we have for the week is just this D here. And it's a nice profile at the moment. It's really clean. It's very distributive across the top, marking out that line in the sand around the 77 area. And if we were to snap some fibs, it does look like we hung up around the 50 of our own week. But we're outside of the value area. It's getting shallower as we drop lower. And there's not a lot down here to help us out. If you look at last week, if we carried forward that point of control, we've already ran through that multiple times. It's hard to imagine that there's much left at that level to help us out. The entire zone here is a high volume node, and that covers us down to 66.50. But then what? Right? Then it gets really shallow, and we could drop into 65.50 relatively easy. Remember, we're running 50s, not hundreds. So we don't anticipate 6,700 helping us out at all. If we flip there like we did earlier this week, great. I mean, it is an options level, so you don't want to ignore it. But if that level breaks, we're just going to run to the next 50 point. And the upside is likely capped. Even if we get through this point of control, we got this other one back here, and they're close enough together that they create this zone overhead, this significant resistance zone. We can get through it, right? Because price can do whatever the heck it wants, but it would have to be something significant to get us through that level. $10-day, 30-minute volume profile in TPO. Not a lot here, really. We're inside the value area. We're still wiping these candles off on the backside. But now that we spent 3 days at that level this week, it's likely we're going to see the point of control stay there. The only other thing that I think could move it at this point is getting down into this 67.11 area where we see the point of control on the TPO build this spot out at 67.11 cog line and bring that point of control down. That would certainly help us out, would remove that level from overhead. But to fill out 67.11, we've got to actually get to 67.11, which means we would be sort of cheering for a little weakness. Works for me, 6,700 to 6,732 cog line. We just hang out there, build it out, or maybe this zone. Kind of put some structure around that to bring this point of control down. The trick to all of that, though, would be to stay above it or to get back above it if we did bring it down so that we could then make moves to the upside and not have it overhead as resistance. We've still got that 67.92 cog line. It continues to hold out. We haven't hit it at all. It is the line in the sand we continue to keep our eye on. At this point, it's got to be a first touch play. No new VPOC from yesterday. We've crossed that level many times already in the overnight, so that doesn't have any value. The textbooks would tell you to carry forward these value area highs and value area lows. I've got enough pivots. I don't need these, but they are there. And another level that stands out is this 71 area, 70 and a half right there. This high volume node really stands out. So if we can break above our own Globex high and we make a run for it, that's an area of concern. We got a nice shallow area here so that if we do get the breakout, move through the shallow zone relatively easy, all things considered, then this high volume node, once we get through that, then it gets shallow again all the way back up into the highs. But we have Tuesday's point of control up there, and that's multiple levels of resistance. And then above that is the 92 cog line and the VPOC. So I would keep that level on your radar if we get an upside breakout. We are almost back to Friday's close. So if you think about how we ended the week last week and how bullish we were at the open on Monday, and now we find ourselves like the hamster on the wheel, right back where we started again. All that work for nothing. I've mentioned before that these big funds and firms, they don't like to just keep throwing money at it if they don't get returns on their effort. Just like anybody else, right? If you continue to try to do something and you don't see any positive results for your efforts, what are you going to do? You're probably going to try to do something different because what you're doing isn't working. Well, one of the things that they do that are to shake it all up and to do something different is they'll wash it. They'll just dump it all and start over. That sort of flash crash behavior can wipe out 200, 250 points in a day, and it would just clear the board, give them a nice chance to run it back in the other direction. I don't think we're there yet, but it has to be considered when we spend more and more and more time within this range. There's a tool that you can use called LinReg or regression line. If you were to look at these candles, maybe you don't see their directional bias, but that line shows it. It is an ugly grind higher, but it is a grind higher. So as we continue to build out more candles, even if we don't yet get out of this range, as long as this line don't start to flatten out and then begin to curve to the downside, this is still intonating a positive outcome. We're back at the 10-day. I know it says we're below, but we'll dance around that line. There's a bit of an imaginary box above and below the 10-day. Imagine channel lines like Bollinger Bands or Keltner channels that hover around each side of the 10-day moving average. And within those bands or those channels is like free safe area. Price can get into that range and we'll see the flows change as long as we're sitting inside those ranges. That's a kind of the same work that it takes to validate cog line, which is why it takes so long, 2 or 3 months to validate a cog line. To see the sort of market behavior around those lines and levels, the pace of the tape, the size of the trades, the frequency of the hits. When we're inside of this 1 point range, half above, half below, it's not a bad place to be. So if we get below the 10 and we're not more than a half of a percent below the 10, it's not a bad thing. Getting below, say, 1%, sure, the dynamics change at that point. But if we're within this sort of collar, all's well, and we are still inside that collar. So it might not sound good that we're below the 10-day, but at this point, it's not a risk. It's a nice reset too, by the way. And looking at things for the week, we're still more than 1.5% above the 10-week. So everything is fine from that perspective. We continue to move lower and lower here. If I was to snap that regression line like I did a few moments ago, it would be clearly pointed lower. These swab bars are also indicating the same thing. We're getting less bounce each time, but we're still above the 10-week. And even when we got back to the 10-week, we didn't drop significantly below it. Maybe that would be the wash when we finally do get one, is that they take it to the 10 and give us a good 1.5%, 2% drop below it, just to shake everything loose before we run back out again. Either way, this is showing that we're still good. These charts are kind of noisy, but if you look at them for a couple of years, you kind of get used to it. There's that white line that I used on those very few candles on every one of these charts, that regression line. The top 3 sectors are the risk on sectors. If everything is good out there, those are the sectors we expect to do good. If we're looking for a rally day, those are the sectors that we have to have. Now, they're really generic. XLK is tech, right? That's really generic to just say tech. Chips, cloud computing, old tech, new tech, the kind of tech matters. So any of those, if we get them running to the upside, would really help, even if it's not just specifically XLK. And consumer discretionary, the other one, XLY. A lot of the Mag 7 is in consumer discretionary. So those top 3, we need those if we're going to rally. If the rally is based on growth versus value and Mag 7 pushes and those sort of things. If we're going to get a 0-day flows or a move from treasuries or bonds, then of course we don't need those. The bottom 3 is the risk off sectors, but it's broken. Utilities is in that, and utilities are now directly tied to data centers and AI and tech and the whole thing. So while that's supposed to be a sector that ties into a flight to safety and more of a value play, it doesn't fit there anymore. And there's not a solution to this problem yet. Still working on it. But if things are going to get weak or stay weak, then those lower sectors are what we would anticipate as a flight to safety and a capital rotation dynamic. Money doesn't really leave the market, right? It just changes locations. Because a lot of those big funds or firms, they have to pay a penalty if they go to cash. And you don't want to have to go to your investors and report a loss, not because you risked their money and it didn't work, but because you were too scared to take any risk at all and you had to pay a fee for it. If you're going to lose my money, at least try to make money on this off of it, right? So they're not going to just sit out. They'll go from one spot to another spot. And that's what we want to try to catch if there's a rotation. The three in the middle are the midline. They tend to do good in bullish or bearish markets. They're kind of interchangeable to a point. But if you look at the white line that's buried in there, tech is still pointed higher with the Linreg line. Staples is basically sideways. It's slightly lower. Healthcare, certainly lower. And of course, utilities, as I said, is broken and it's pointed to the upside, a lot like tech, financials. So it's a bifurcated, broken market out there. A lot of things just not, the signals don't make sense. We got a lot of divergence. Got flows showing up in strange places. So if it ain't broke, don't fix it, right? For today, it always comes back to GTFO. Start with what we have. Our Globex high to our Globex low. That's the immediate box that we need to get out of. Outside of that, the RTH high and the RTH low of yesterday, that's the second box. And then all of yesterday's high to all of yesterday's low, that's the third box. Now, if we head to the downside, there's only two boxes. The third box only applies if we make a run to the upside. So you got the mid from yesterday, just in the RTH, and the mid from yesterday if you capture the whole thing. And as you'll see, it didn't really change all that much from 33 to 39. If we get the breakout of yesterday's range, then we got the 111 and the 1236 to play the reversal and come back in again. That is by far my most profitable trade and my favorite trade. Yesterday's 111. So we'll see it when we get there, if we get there. Either side doesn't matter. Top side, bottom side, we'll play the 111, anticipating the reversal and coming back in if we get there. Because depending on how we get there, there's no reason to expect we're going to continue to go in that direction. Unless it's some headline that freaked out the market and they're all trying to chase it. Right? Pretty simple. It's just that kind of day. So be careful, be safe, keep your eye on the clock. I'll see y'all tomorrow.